Good morning on this frosty lockdown Friday morning. I was getting dressed for the webinar this morning. I had to put on something smarter than usual during the lockdown. I had to put on a jacket and my wife says it matches my slippers. So yeah. My name is Sean Smith. Today I'm going to be talking to you about employee ownership as a tool to address BE ownership. Transcend Capital is a business that helps other businesses structure and implement BE ownership transactions, and obviously employee ownership is a potential option within that. If we look at what we're going to go through today, I'm going to be talking about employee ownership, what is employee ownership, the benefits and key success factors, also key structuring principles, the importance of managing employee expectations, and then of course BE ownership recognition through employee ownership. Just before we get into it, I just would like to give a brief introduction to Transcend for those people who are new to the webinars or new to the business. Transcend as a group consists of 3 businesses. There's Transcend Corporate Advisors, which helps businesses build sustainable BE strategy that makes business sense. And essentially they look across the entire scorecard with a lighter touch on BE ownership. Transcend Talent Management is effectively a niche talent advisory firm and recruiter that assists businesses with authentic resource transformation. And then we've got Transcend Capital. As I said, I'm a director in this business, and we are a specialist corporate finance advisory firm that looks at structuring and implementing BE transactions. A lot of the work that we do is for multinationals and SA corporates. The group was established in 2005, and since then we've obviously gained significant experience, and we've got a strong and skilled team. And I'd say we have a culture of adding value, service excellence, and driving real transformation. I'd also just like to talk about our webinar series. Again, if you're new to it, welcome. If you've been on a couple, I hope you've enjoyed them. We've had good feedback so far. We hold about 2 webinars each month. I think the last 2 covered BE ownership again, but particularly the net value implications under this sort of COVID-19 environment, as well as employment equity. And we've got one coming up in a couple of weeks on skills development for persons with disabilities. For more information, please look out for our mailers or check out our website. Okay, so getting into today's order of business. Firstly, I'd just like to review employee ownership. So, at a high level, employee ownership involves eligible employees participating in ownership of the company. And obviously that's very broad. The truth is employee ownership comes in many, many different forms or different structures. We'll be talking about some of them today. Employee ownership as a principle is very well established in the USA. And over the last decade, there's been notable growth in UK and Europe particularly. Interestingly, when we were doing research on this, we saw that even Russia and China are looking at some forms of employee ownership. In South Africa, it's mostly been implemented as part of BE ownership initiatives. If you think about the structure of employee ownership, typically you would have the measured entity or operating entity that would obviously have its existing shareholders, and there would be a vehicle introduced through which employees would participate in ownership in the entity. And that vehicle is most often a trust, but it can also be a special purpose vehicle company. Now, obviously, sometimes shares are granted to this vehicle, but most times not. Most times there's a purchase for value, and that purchase for value needs to be funded, and that funding typically comes from the company in many different forms. So obviously it's got to make sense in the context of the transaction and the business itself, but that funding is either in the form of a loan, sometimes preference shares, and very often notional vendor financing. And as I said, the ownership would be held by this vehicle, and the employees would benefit as beneficiaries, for example, of a trust. If we look at the benefits of employee ownership, we can really look at this as benefits to the business, benefits to the employees themselves, and benefits to society as a whole. So if we talk about benefits to the business, a lot of research has been done around this, particularly in the States and in the UK. And what the research found was most often there is an improvement in business performance after implementation of employee ownership structures, and an improvement in profitability. And I think that comes because of greater employee engagement and interest in the business. And ultimately that drives improved productivity, innovation, competitiveness, and ultimately profitability and sustainability. And I think that's really important in the context of what's happening at the moment right now. You know, sustainable businesses are under a lot of pressure, and that sustainability is super important. Also, if we think about the battle for skills, again, very relevant right now and in South Africa as a whole. We have a skills shortage, so implementing employee ownership schemes give you an opportunity to attract strong skills and retain good talent. Employee ownership also provides an exit mechanism for existing shareholders. And again, this is very common overseas, where employee ownership is used as a tool for shareholders to exit. And you know, we've been involved in many structures in South Africa where your existing owners of the business implement employee ownership schemes and take that opportunity to wind down their stake in the business. And of course, the final benefit is BE ownership recognition. I'm not going to talk broadly about BEE and the importance of BEE. I'm going to be covering BE ownership recognition through ESOPs in a lot more detail later on, but obviously that's very important for South African businesses. If we look at benefits to employees, obviously I think the primary benefit is really the financial benefit to employees and their ability to strengthen their financial position. I mentioned earlier that typically with employee ownership schemes, there's increased engagement and interest by the employees. And obviously this is important to the business, but this is also very important to the employees themselves. And I think beneficial to employees themselves. I think everyone wants to be more engaged and more interested in what they do, and especially with their work, which takes up a large part of your life. And lastly, typically employee ownership schemes would give employees a voice in key business decisions. Now, that doesn't necessarily mean that each employee will be attending shareholder meetings or attending board meetings or anything like that, but typically there would be a trust, as I said, and there would be elected trustees of a trust, and the employees would take part in nominating and electing those trustees, and those trustees would have a voice. Very often they would have board representation, depending on the size of the scheme and nature of the scheme, and of course would be entitled to participate in shareholder decision making. So, you know, through their nominated representatives, employees do have a voice, and definitely have more of a voice than in a situation without employee ownership. Lastly, for society as a whole, you know, having a more financially empowered workforce and community or society is obviously beneficial and will strengthen the overall economy and economic activity. Again, very relevant in the South African context. So I've spoken about the benefits of employee ownership. I think it's important to also talk about key success factors. And I think before we go into detail about what the key success factors are, I think it's important to understand what your objectives are. So always bear in mind what you're trying to achieve through employee ownership. If you're trying to, you know, fundamentally change the way the business works, change employee behavior, significantly increase their interest and engagement, then, you know, you need to look at a different set of success factors to perhaps saying, well, my primary objective is just to address BE ownership. And I wouldn't mind some kind of financial benefit to employees, but there's no sort of fundamental push to change the way the business operates and change employee behavior. So I think it's important to understand what your key objectives are and then what the related success factors would be. So we actually did a lot of in-depth research into key success factors for employee ownership. And what we're covering today is really just the sort of tip of the iceberg. But what we found really can be broken into these following key success factors. Firstly, employee education and training. This is obviously education and training around the ESOP itself and understanding the rules of the scheme and the workings of the scheme. But very importantly, it's also training on basic financial literacy and ownership fundamentals, because very often this is lacking. And without those, you're not going to really understand how the scheme works, how your benefits potentially could unfold, and what the drivers of value would be. I think there's also value in education and training around what success factors are for the business. So what drives value in the business? What makes the business successful? And obviously that's very contextual. But this collective education and training around these different factors or facets is important. Next, fairness. Fairness is very important. I think that goes without saying, that if employees don't have trust in the scheme and don't believe that the scheme is fair, there will be no buy-in, no matter what other training or other sort of processes there are. If they don't believe it's fair, it's not going to be a successful scheme. So this is very important and is obviously managed through the actual structuring of the scheme, and looking at what the potential benefits are and how they could potentially unfold, but also through communication and training. So a lot of these are intertwined and sort of talk to each other. The next factor is a meaningful ownership stake. And this is primarily talking to the ultimate sort of financial benefit. So you obviously can't necessarily guarantee that employees are going to walk away with X rand value. But I think in terms of the initial structuring of the scheme and looking at how it's going to work and what potential benefits to employees there could be, one needs to consider whether that would be seen as important or meaningful to the employee. So you don't want to create a scheme and launch the scheme with a lot of celebration and excitement, and then a year down the line employees are paid out 200 rand. I think they're more likely to see that as a slap in the face rather than something to celebrate and be excited about. So this is really important. And I think what's important about employee ownership is, obviously this is potentially going to provide BE ownership recognition, but you're delving into the employee-employer relationship space. So as much as this can and hopefully should be a very positive initiative, there can be negative consequences if expectations aren't managed, and if ultimately actions are taken which damage that relationship. So next is an increased ownership culture. And this is, again, a success factor, particularly if you're trying to ultimately change employee behavior to act like owners in the business. And this increased ownership culture is looking at an adoption of and commitment to supporting ownership values. And also what's very important here is buy-in from the leadership team and from management. So it's got to be sort of driven from the top, this ownership culture. And also what's important here is reinforcement of teamwork, the fact that, collectively working as a team is ultimately going to add value for everyone. The next success factor is commitment to pursuing business disciplines. And in this respect, it's really around measuring and reporting on key business metrics. And this does, again, tie through to the employee and education training, where there's potential training around what drives value for the business. So we need to make sure there's an understanding of that, and then measuring and reporting on this, and importantly, celebration of success. So when the business does achieve its key targets, there needs to be, business-wide celebration. The next success factor is a well-governed fiduciary body. I think that goes without saying. Governance is very important. And again, as I mentioned earlier, you want to build trust in the scheme. So you need to have trust in the fiduciary body, who's ultimately going to be key influencers or change agents. The fiduciary body needs to have representation from the employees and unions where relevant, and also would have representation from the business itself. I just mentioned unions now. So where unions are relevant, where employees are unionized, there needs to be a union support. And you need to think carefully about at what stage is best to engage the unions and discuss the scheme with them, and get their support of the scheme. And again, this is often very contextual, looking at the individual businesses, relationship with the unions, or with the relevant union, and how best to approach this. Lastly, the research key success factor was employment of specialist advisors. As you can imagine, this is quite a complex space that's dealing with various facets, from financial aspects to the softer aspects of employee relations, and obviously BE ownership in the South African context. So I think employment of specialist advisors definitely helps in this respect to guide the process. Now I'd like to look at listed versus unlisted ESOPs. When we look at listed ESOPs, I mentioned earlier that ESOPs come in many different forms, and listed ESOPs aren't any different. There are many, many different structures where employees hold shares, listed shares directly, or participate through unitized structures. Some schemes have a fixed term, some are evergreen, some schemes involve providing free shares to employees, and some have shares acquired at value, or a combination. But I think very typically in the listed ESOP scheme structures, there's ultimately the case where employees end up with shares that are tradable in the open market. And that provides almost a liquidity mechanism for them to receive value, because they can go and sell them in the market. So as I said, that's sort of a key feature of listed ESOPs. Some of the companies in South Africa, the listed companies that have implemented ESOPs, include the likes of Clicks, Barloworld, Vodacom, Hulaman, and Mr. Price, and there's many others. If we look at unlisted ESOPs, again, there are many, many different ways of structuring this. And I think particularly in the unlisted space, there's probably more opportunity in terms of structuring a scheme to achieve what makes sense for your business. And that ranges from profit sharing structures to capital appreciation structures, and similarly evergreen structures or fixed term structures. But I think in the unlisted space, it's very seldom that the employees would actually hold shares directly in the company itself. They would almost always participate through a vehicle, a trust, or an SPV company, and in either through a trust have a unitized trust structure, or otherwise have some kind of participation method which measures their proportionate participation in the ownership without actually holding shares in the underlying company. Now, obviously, a key difference for unlisted ESOPs is the fact that there's no open market that the employees can go and sell their units or sell their shares to. So I think ensuring scheme liquidity and value delivery to employees is very important. And in this respect, the structuring is crucial. So I think the process of carefully planning and structuring the scheme in the context of the business, understanding the value profile and profitability of the business is very important, and seeing what kind of structure makes sense for your business. And how could we structure a scheme that enables scheme liquidity and value delivery. In terms of value delivery, I'm not saying that there should just be value paid across to employees in whatever scheme, and despite business performance. I think there definitely needs to be the risk and reward relationship that other owners of the business have and experience. So I think that is relevant and needs to be taken into account in structuring ESOPs. But what I'm saying is we need to look in the structuring process of how to achieve the scheme liquidity and how will we ultimately deliver value to employees. This kind of ties into the next slide, where we're looking at key ESOP structuring principles. So, I mentioned risk and reward. I think that ties in with the principle of aligning shareholder and employee reward. And essentially through an employee ownership scheme, that's exactly what you're doing. So you want everyone driving towards the same goal of value creation and mutual success for everyone. In the South African context, in light of BE ownership, you obviously want optimal BE ownership recognition. So I will be talking about that in a little bit more detail shortly, but I think what's important here is not just looking at the upfront recognition and the percentage recognition and scoring, but it's also the potential evolution of point scoring and recognition. And what's really relevant here is the net value and the value creation to the scheme, because that will ultimately impact your net value points. And I'm not sure how familiar you are with the ownership scorecard, but net value is a critical aspect, and net value is looking at value creation in the BE investor's hands. So in this case, in the ESOP's hands. And if there's insufficient value creation, obviously there won't be value flow to employees. But from a BE ownership perspective, you will potentially incur a penalty and drop a BE level, because ownership is a priority element. And if you're not achieving a sub-minimum level of net value to the BE investor, then you potentially could incur that penalty. Looking at simplicity and transparency, in looking at possible scheme structures, they can be extremely complex, and particularly if you're trying to structure them in certain ways to achieve certain objectives, benefits for employees, benefits for the company, tax benefits, accounting structures, they can be very, very complex. But I think what's important at the end of the day is, even if the actual underlying structure ends up being fairly complex, the overall communication needs to be simple and transparent. And ideally, you want the actual scheme structure itself to be as simple and transparent as possible. Again, this ties through to the principle of getting buy-in from the employee body, from unions, and building trust in the structure. And I think the simpler and more transparent it is, the more you can achieve that. I've mentioned fairness earlier. I'm not going to talk about that again. Tied into the previous point. Looking at tax and accounting, this is often, tax is always important, but I think from an accounting perspective, it's critically important for listed companies. There very often can be quite nasty accounting implications for structures like this, or any share-based payment kind of structure. What we often find for the unlisted companies is sometimes less of a concern around the accounting implications, but definitely it is important. From a tax perspective, it's very important to understand what structure you're looking at implementing and what the related tax implications would be for the company and for the participants themselves. Most often, for the participants, they would be taxed as, or the benefits that they receive, the economic benefits that they receive would be taxed as income at their marginal tax rate. But again, it is dependent on the actual structure itself and how it works. I've mentioned liquidity for distributions. Again, that comes back to ultimately how we structure the scheme and how we can potentially facilitate cash flow through to the scheme when there has been value creation, in order to transfer some of that value across to employees. And there are many ways to achieve that through scheme structuring. So I've spoken about potential scheme structures. I've spoken about the benefits and key success factors, and I think in a couple of places I've spoken about the importance of managing employee expectations, but this is arguably the most important thing when implementing an employee ownership scheme. And I think there's two aspects to this. One is the employee communication and training. And I think what's required there is, again, trying to make sure that the scheme can be communicated in a simple and understandable way as possible. You want to be able to decode complex scheme rules and legal jargon into a simple communication so that everyone can understand this. I think it's important to actually have a tailored communication and training program. And often this would involve, ultimately through the rollout of it, facilitated interactive sessions, but sometimes there's videos that are created, posters, FAQ booklets, obviously presentations. So there's many different tools that can be used through this, but we found, a combination of these tools is very effective, and particularly having interactive sessions with the employees, sometimes in different languages, depending on the employee body and ultimately who's participating in the scheme. I mentioned the importance of a union engagement in a unionized environment. Again, this is crucial. You need union support. The second aspect of managing employees' expectations, I think, is managed through trustee training. So ultimately, the employees would be able to nominate and elect trustee representatives in the case of a trust. Most often the schemes are through trusts. And you've got to make sure that this fiduciary body is able to fulfill their role. And so training and education is super important here. And this is beyond just training and education in terms of the scheme workings itself. Again, it's financial literacy, it's ownership fundamentals, but it's important to have training around the business itself, understand what drives the business, what drives business value and business success, and also training around this fiduciary role. So what are the fiduciary responsibilities? What are their powers? What are their duties? I think it's super important to walk away that you have an empowered fiduciary body that in which the employee body has trust and can communicate with. Again, facilitated interactive training is very effective. Okay. Now, to talk about BE ownership recognition requirements for an ESOP trust. So what I'm going to cover first is really what do the codes require. So the ownership statement in the code statement 100 sets out a whole lot of requirements that need to be met if you want to recognize BE ownership through an employee share ownership program. So I'm going to cover that. I also want to talk a bit about the BE Commission, and also I think that just the DTI's general view of employee ownership. So firstly, looking at the requirements around trustees. Okay, the codes require that at least 50% of the trustees are appointed by the employee body. So as I said, they'll go through a nomination, typically go through a nomination and election process. So that at the end of the day, at least 50% of the trustees are employee representatives or union representatives. Typically, the balance of the trustees would be representatives from the company themselves, and very often there would be an independent trustee who's also supporting the overall body of trustees. From a beneficiary perspective, the codes state that the trustee must define the employee participants. And in that respect, they say, look, you can either name individual participants, or you can define a group of natural persons. So in the case of an employee ownership scheme, this is pretty easily met. Seldom would you name each person, but rather you would describe the eligible body of employees that would be able to participate here, and it would be clearly defined and measurable. So that's typically easily met. Then the codes also say that the trustee must define the employee's proportion of claim to receive distributions. And again, they say here, well, you can either name the people and define for each beneficiary their percentage claim to participation in the scheme, or you can set out formulae that essentially will allow the trustees to work out the proportionate claim to benefit. So most often it would be the latter approach, where there would be sort of some kind of formulaic benefit calculation through which you would calculate the value flow to the underlying employee beneficiaries. But I think the key principle set out in the codes is that trustees mustn't have discretion with regard to who's participating and how much they're going to participate. Typically, the scheme rules would be set up in the trust deed or whatever constitution of the scheme, and they would be very clearly defining ultimately who's going to benefit and how they're going to benefit. How's the scheme going to work? What are the rules of the scheme? And the trustees would then be just really carrying out the scheme. From a termination perspective, the codes require that on termination, all sort of residual value or accumulated economic interest is paid out to the beneficiaries. I think this is quite important. So I mean, this is easy to draft into the codes, and typically this is what would happen. If there is residual benefit, it'll be paid out to the employees at that point in time. But I think what's important here is again, the scheme structuring and understanding the potential value flow. We've seen a couple of schemes that are created where there's not a lot of value flow to the employees over the scheme life, and potentially on a wind up, there's significant residual value in the scheme, and the lucky employees that are around at that point in time get quite a windfall. And that's not necessarily the best way of structuring it. You almost want to try and structure it in a way that will allow sort of an even flow of benefit to employees over the overall scheme term, or if it runs on indefinitely. But you want to try and avoid a situation where there's a massive amount of cash that is suddenly going to be distributed to employees on termination. From a governance perspective, I think before I talk about what the codes require, I just want to emphasize the importance of scheme governance. So there's been, I think, criticism of broad-based ownership vehicles in general, and that's broad-based vehicles such as, educational trusts, charitable foundations, community trusts, and employee ownership schemes. I think the criticism has been that, many of these schemes have been legally set up and perhaps they hold shares in businesses, but they haven't been real. Some of them, there's never been a single meeting and no benefits paid out. So I think there's been criticism around the governance of these schemes and the administration of these schemes and value flow to beneficiaries. So it is really, really important that if you set up any broad-based structure, but particularly for employee ownership schemes, that you have very strong governance and you have very strong administration. And again, this ties back to that empowered fiduciary body who understands what they need to do and have the skills and ability to carry that out. So talking about the actual requirements in the codes, they state that the trustees must present the financial reports of the scheme at annual general meetings. So what that means is you typically have an AGM and you present to the employees at that AGM. I think part of that would be talking about the business performance. The ESOP's asset is really its shares in the business. So you need to be talking about business performance and also you'd be presenting the financial reports of the scheme. If there were any sort of key matters in which you would need employee feedback or participant feedback, they could potentially be voting at those meetings as well. One of the other governance requirements set out in the codes is that participants must be able to participate in managing the scheme at a level similar to a shareholder holding shares in a company. So we think that's achieved through the AGM process, also through the ability for the employees themselves to nominate and elect trustees, and also with them having access to the financial reports of the trust. Lastly, there's a requirement that the trust deed or constitution of the relevant scheme is available to the employee participants. So that would obviously need to be made available. There are also additional criteria that are set out in the codes, whereby if you want to avoid being limited in terms of the percentage ownership recognition and related point scoring, that you need to meet these additional criteria. And essentially the additional criteria talk to the ability to show a track record of operating as an ESOP, or in the absence of such track record, evidence of operational capacity. And it's a bit strange here, the codes talk about this operational capacity as having premises, having employees, having advisors, and if you think about an employee ownership scheme or any broad-based trust structure, you're not necessarily going to go and rent premises or hire full-time employees. Very often you would have advisors or administrators, but I think in practice the verification agencies don't look too much to the actual letter of the codes there. They don't go see that you have premises or employees, but rather they look at this and they say, look, has the scheme been real? Has the scheme been well governed? Has it been operated in line with its constitution? So again, that ties back to the governance and administration and the importance of strong governance and strong administration. Now, those are the requirements set out in the codes. I'm sure you're aware that the BE Commission has been fairly vocal around broad-based ownership structures in general. They're not a huge fan of trusts. And I think the sort of themes that we've picked up from the BE Commission include a couple of things. So for example, that there needs to be beneficiary participation in value creation. And again, that's talking to the actual sort of value flow to beneficiaries, that these schemes must be real. I think there's been a key concern around identification of beneficiaries. I think in the ESOP context, it's not super relevant because you have a defined body of persons, but where that's come in is particularly in other broad-based vehicles where you don't have named beneficiaries or a tightly defined group of persons. They don't like this discretionary ability to choose on an annual basis or whenever who's in and who's out. They also are concerned about active involvement by the underlying beneficiaries. So it's important to structure a scheme to best meet this. And again, through some of the aspects that we've spoken about before, I think this can be achieved. Another one of the BEE Commission's concern has been around unrestricted ownership by beneficiaries. And this is the ability for the employees to realize value through this ownership. So again, this ties through to the actual scheme structuring and how best to try and meet this. And again, sometimes, there's a bit of a trade-off here between the commerciality of setting up the structure and trying to meet the BEE Commission's requirement here. And often there's a bit of headbutting in this regard. I think the last area that the BEE Commission's had concern around is founder control. So some structures are set up where many actions can't happen without founder consent, or almost no actions can happen without founder approval. And I think the BEE Commission looks at these and feels that the schemes should be more independent and be able to sort of make their own decisions. So, again, I think there's a balance there, but, very often if you look at setting up a structure where there's very, very strong founder influence and founder control, that's going to be a problem. So I think that's the BEE Commission. I think what's important, though, from the perspective of the overall DTI, is that Ibrahim Patel, the Minister of Trade and Industry, feels quite strongly that employee ownership is almost going to be the next wave of BEE and should be included in the next wave of BEE. So he feels very strongly that worker empowerment is important, and we know that the BEE unit similarly feels that properly constructed and implement employee structures or employee ownership structures are important and very relevant and very valid. Okay. The last thing, excuse me, the last thing I just wanted to cover is really what the possible ESOP impact is on your ownership scorecard. So what you see here is the BEE ownership scorecard. For those of you that are unfamiliar with it, it's really broken into 3 categories: voting rights, economic interest, and net value. Voting rights is talking about the ability of BEE investors to participate in shareholder decision making. Economic interest is really looking at the ability of the BEE investors to participate in the financial fruits of the business. So typically this would be dividends and or capital appreciation. And net value is looking at the actual wealth creation in black hands. And this is essentially looking at almost a net asset value position of the BEE investor, where you're looking at the value of the shares in the business, less any related outstanding acquisition debt. So it's asset minus liability, hence the net asset value view. And I just want to highlight again the importance of net value. So net value is measured against escalating targets over time. So there's increasing targets for value creation. And as I mentioned earlier, BEE ownership is a priority element in the BEE codes, which means that if you do not achieve a sub-minimum score for ownership, then you are potentially penalized and can drop an overall BEE level. And that sub-minimum target is actually just focused on net value. Essentially, if you're not, there's 8 available points, and if you're not scoring at least 40% or 3.2 of those points, then you will incur that penalty. So again, scheme structuring is very important, and understanding the evolution or the potential evolution of value is important. Of course, you arguably potentially looking into a crystal ball, but how you structure the scheme can often mitigate net value risk. So it's definitely manageable. So where would an employee ownership scheme allow you to score points? So obviously, this is largely dependent on the black participation in the scheme itself. So for example, if you implement a scheme, let's say it was a 25% scheme, and 80% of the participants were black employees. What that would mean is effectively you have 20% black ownership. So although you have a 25% scheme, you would be sort of limited in terms of some of the scoring on the scorecard. So that's important to take into account. Similarly, from a black woman perspective, understanding the sort of gender profile and demographics of the scheme is important to understand the overall potential scoring here. I think what is important is that very often a broad-based structure like an employee ownership scheme lets you score the economic interest points that are available to broad-based ESOP or designated groups. So there's 3 points available there. And often through this kind of structure, you can score these points, and in other type of structures, sometimes you cannot score these points. And similarly, from a black new entrants perspective, black new entrants are defined as the investors that previously haven't held equity interest worth more than 50 million rand. So, in the context of an employee ownership scheme, very often these are seen as black new entrants. And what this means is that if you compare points through an employee ownership scheme versus certain other potential B investors, there's up to 5 additional points that could be scored here. And again, the importance of net value can't be understated. You really need to understand that. And that can be partially managed through the scheme structuring up front. For example, will there be a B discount offered on the shares? Also, what's the expected pay down of debt over time? What are the funding terms that are provided to the scheme, and how will you actually how we establish the funding of the scheme? So that's very important, and also it's important in the context of the expected value creation and equity value of the business over time. So what I wanted to add there as well was, certain businesses say, look, because we just want to implement a structure that will optimize our BE ownership scoring, can we implement a structure that is just for our black employees? So yes, it definitely is possible, but we would just caution against the possible, implications of implementing certain benefits just for black employees versus all employees, and the possible overall impact on employee relations. So we think it's better to almost structure schemes in a way that allows you to almost structure or look at the different potential participants of the schemes, and optimize the overall BE recognition by choosing ultimately who's going to be participating in the scheme in an objective way with objective rules. Okay, so I think that's really it from a BE scoring and recognition perspective, and that's largely me for this morning. I think just in conclusion, ESOPs are a tried and tested approach to addressing BE ownership. I think over the last 10-15 years, there's been a lot of ESOPs that have been implemented in South Africa, most of them very successfully so. As I mentioned, there are various potential benefits for the business and for the employees and for society as a whole. I think you need to be aware of the key success factors, importantly in the context of your specific objective. So know what you want to achieve out of it, and then what the key success factors are to achieve that, and whether they match and whether it's feasible for your business. And again, I can't underestimate the importance of managing employee expectations. It's absolutely vital, and as much as you may take a lot of time in structuring the scheme and legal implementation, I think it's worth investing the time and effort into a strong communication program and rolling it out in a strong way. Again, governance and administration is very, very important. So you need strong governance and strong administration, and an empowered fiduciary body that are able to fulfill their fiduciary role. Lastly, I just wanted to cover how Transcend can help you. So since 2005, we've advised on multiple ESOPs across many different industries at listed and unlisted level. Actually, the first deal that we ever did was an employee ownership scheme. That was 2005, 2006. We offer turnkey ESOP solutions. So I think we're in a unique position that we, with our experience, we understand employee ownership from the perspective of the beneficiaries as well as the implementing companies themselves. And we're able to offer support through feasibility analysis, identifying what options are available, and then identifying optimal scheme structures that make sense for your business. and then driving legal implementation, and also the communication and training program development and rollout. Again, that is super, super important. So just before I finish off, I just wanted to say, if you do have further questions or you want to discuss how employee ownership schemes could be a possibility for your business, please do be in contact with us. We'd gladly have a chat with you. And otherwise, thanks for your time this morning, and enjoy the rest of your Friday. Cheers.